Thanks. I'm Gary Cohen.
Let me make sure I know how to do this correctly.
Chris will probably talk through a lot of the early stuff. And again, the banker a lot of times is looking at hard numbers when when you're looking to get a loan or a line of credit, and they're looking at ratios, et cetera, et cetera. And the CFO, when I'm in there either assisting or whatever, we're trying to do what we can to improve things in the business that get to those numbers that Chris is looking at. So those are, I guess, sort of the two perspectives that we're working with.
Right, yeah, and the two perspectives really tie into each other closely because Gary and I work together a lot. I, as a lender, working with business clients in the market and then commercial real estate investors in the market. I'll call on Gary often. Gary's a CFO, but he's a consulting CFO, so his role is going into companies and helping them a lot of times with develop those financial report cards, develop those metrics. And when I see sometimes opportunities with companies where I think they could be doing better in certain areas, I will call on Gary, absolutely, and he does a great job of helping those companies to improve and to maybe make themselves more lendable and to achieve their goals of growth. So the first thing we want to talk about, I think the recession word was in the beginning of the presentation. It was on the title or something like that, and I know we're hearing it a lot in the news right now. As I talk to people around the room this morning, and as I think about my business, because people were asking me how things are going really well right now. I mean, I feel like we're in a great position. One thing you can say for sure about recessions is I at least the couple I've been through in my adult life, you don't typically have someone that tells you, hey, we're about to start a recession. It's happening, right? We usually find out about it. It's a lagging situation. We find out 2 to 3 months later when the Fed meets and they say, hey, we went into a recession last quarter, so it's too late at that point, right? So what we're going to talk about today is looking at some of these leading indicators. This is just going to be very brief, and then we'll go into some of the financial ratios, the things that make up a good financial report card, and Gary will talk then about some of the KPIs that you can develop to improve on those financial ratios. Give yourself a straight A report card. So when we talk about economic leading indicators, this is just a few of them, but I thought these were things that were really important for us to cover. Interest rates is number one. I mean, if you're going to look at anything as an everyday person, pay attention to one thing as a leading indicator of the economy, it's going to be interest rates. Right now, rates have been kind of a strange position lately where we had the last couple of years, prime rate, which is based on the federal funds rate, that's the rate that is controlled by the Fed. They come, they meet 6 times a year, and they have these meetings, and they decide if rates are going to go up or down. And they had been raising rates pretty consistently for a while, and the messaging was that rates were going to continue to be raised. When they're raising rates, what they're trying to do is temper what could be an overheated economy. In the last 3, maybe 6 months, we had some tariff scares, we had some other stuff slowing down globally in the economy, and that caused the Fed to take pause and say, all right, let's rethink this. Should we really keep raising rates as aggressively as we have? So I've been paying a lot of attention to interest rates. Has anyone heard the term yield curve inversion recently? It's been the thing in the news, right? So yield curve inversion, when you're talking about rates, again, short-term rates are determined by the Fed. Long-term rates, which is the treasuries, those are determined by the market. It's supply and demand. When investors are taking money out of the stock market and retreating to safety to buy US treasuries, those treasury rates are going to go down, right? When the market's really strong, you start taking your liquidity and investing it in stock and equities, those rates are going to go up. So you have that inverse relationship between the two.
Yeah, I think when you see like the long-term rates dropping below the short-term rates, that means there's less confident. People are starting to tread towards safety instead of the stock market. So when you hear, oh, there's a yield inversion curve, typically that's a sign that, ooh, we think there's more of a chance there's going to be some weakness ahead in the economy.
Right. Right now, the short-term rate, the federal funds rate is at 2.5%. The 10-year Treasury rate is at, I think it was like 2.2% yesterday morning. And we've been in that inversion now for probably a few weeks most recently. It first inverted at the beginning of the year. That could be a temporary thing. A lot of it is news-driven right now. If it's something that continues to happen, it's going to be something to pay greater attention to because it may be foreshadowing some possible slowdowns with the economy. Stock market, we always talk when you watch the news every day, if you listen to CNBC in the morning or whatever, they're going to talk about the Dow Jones Industrial Average and the S&P 500. those are good indicators. We all have like our retirement accounts and 401ks that we're paying attention to the market fluctuations. And if you look at that every single day, you probably drive yourself crazy. What I would recommend that you do pay attention to is the Dow Jones Utility Average. The utility average takes all of the biggest utility companies in the United States, and it looks at how they are performing from an earnings perspective. And the reason that that's important is it has a direct tie to interest rates. Utility companies typically borrow a lot of money. It takes a lot of capital to operate and to develop new power management facilities, wastewater facilities, all of these different things. So when you're seeing the Dow Jones Utility Average go up, it means those companies are having higher earnings. If they're having higher earnings, that's typically because rates are lower. As interest rates increase, the cost of their debt increases, you'll see that Dow Jones Utility Average start to go down. So important to pay attention to.
Yeah, me too, in the stock market. I mean, we all try to figure out, gee, which way is it going? Has the 50-day average crossed ahead of the 200-day average? What's the percentage of companies that have hit new 52-week highs versus 52-week lows? And I know Glenn Griffiths with Griffiths Wealth Management back there, he's always trying to figure this stuff out too. It's not a science, it's an art. And as soon as you can read, I read probably 5 or 10 articles a day, and it's still pretty impossible to figure out which way it's going, especially within our political climate, because with our current chief executive, he does things in a different way, and it tends to move markets fast. You hope at some point in time it comes back to an equilibrium, but we tend to have a lot more political news disrupting things than normal, even though the economy in general seems to be on an upswing.
Durable goods report. So is there anyone in here do you buy equipment for your business? Do you have to buy vehicles for your business? And if so, have you done that? Raise a hand, by show of hands, have you done that in the last 3 to 4 years? Have you bought new equipment? Have you bought new vehicles? Yeah, it's been a good time, right? So there's a lot of reasons to be buying those things. One is probably that your business needs them. You need it to grow. Your business is growing. You need to grow that fleet that you use. The durable goods report is a nice report because what it's showing you is what kind of buying activity businesses has. If they're buying new equipment, it's because they're investing in either new lines of business or the lines of business that they have are continuing to grow. So paying attention to the trend year over year and quarter over quarter in the durable goods report will show you if businesses are forecasting continued growth. Really similar manufacturing jobs. It's important to pay attention to. The reason manufacturing jobs specifically are a leading indicator is because the way it works is this. Their customers place an order. As a manufacturer, they need to fulfill those orders. To fulfill those orders, they need workers in the factories. When they hire, they're hiring anticipating fulfillment of those future job orders. So when you start to see manufacturing jobs pull back, it means the inverse. It means that they're anticipating that there could be a slowdown. As I talked to a couple people in the room, we were talking earlier, Jim, I think you guys are probably hiring pretty aggressively right now, I would assume. Anywhere I've read, manufacturing jobs are very high demand right now. Part of that is to do with what we're talking about, which is just strengthen the economy. I think another piece of that is that there's some shifts in the manufacturing process, and there's a need for some higher skilled, high-tech workers in the manufacturing industry.
In a little corollary to manufacturing jobs, total jobs, you may hear a weekly jobs report or a monthly jobs report. There was X number of jobs created this month. This month there was 200,000. This month there was 300,000. With our workforce, the normal people growing into the workforce that get out of high school and college, less the number of people that retire, we need to create about 100,000 jobs a month just to sustain. So if you start hearing over the last 6 months, well, 1 month was 250,000 new jobs, this month was 120, this one is 300,000 new jobs. Our total jobs is going up faster than the amount of population we have. So people who are working part-time need to either come back to full-time. We need people to immigrate to our country to pick up these jobs, or the pressure makes wages go up. So when you're hearing, we've got 300,000 new jobs this month, last month was 250,000, our economy's growing faster than our workforce, and that's a good thing.
And then last but not least, building permits. Building permits is a really good one to look at because typically it gives you about a 9-month look into the future. So when you're looking at building permits, you're seeing how much growth we have in the housing industry, which one, obviously that ties to a lot of stuff in Florida where it's a very construction-based economy, but it's also showing you what's going on the consumer side. If consumers are continuing to upgrade their homes, purchase new homes, young people who are maybe first-time home buyers are buying those first-time homes.
I have a question. Why do they differentiate between farm jobs and non-farm jobs? And it's a lot easier for us. Is that something that you can explain?
Well, I think the key, Gary might be able to jump in on this, but the one thing I know about that is that there's some temporariness to the farm jobs. So what you're seeing is kind of shorter term cycles and what's going on a seasonal basis versus on a long term and an annual basis. And
It's like you'll hear the same thing with retail jobs, because you know, as we get into the last quarter of the year, so they'll have retail job forecast and growth also, because they want to separate off, because to Chris's point, it's temporary.
yeah. So, go ahead.
Building permits. I know you can go to individual counties and or cities, municipalities for the building. Is there anything that, do you have a place that you can say, hey, here's a general building permits nationally?
If you want
Nationally or?
national statistics, NAR, National Association of Realtors, if you go to their website, they have some amazing statistics there. If you're looking for something more local, around here, Urban Land Institute and GOBA, Greater Orlando Builders Association, put out some really good statistics for Central Florida. I would suggest, I mean, if you're looking at it from a global economic perspective, yeah, the national numbers are a great thing to look at. If you're in the construction business locally, if you're in any business that relies upon the construction business locally, then I would definitely be looking at the numbers from GOBA or Urban Land Institute, Central Florida.
And also keep track of the population growth. In our 3-county or 4-county area, we're experiencing typically 60 to 80,000 more people every year. And so whatever your business is, you know, figure out or try to do some type of analysis to figure out if that many people come in, how many typically are going to use our services. Dr. O, I mean, how many people are going to use Nightlight Pediatrics? How many people come in and may need, you know, a plumbing contractor because residential, commercial, big buildings. So try to translate the number of people in the population growth and what type of impact that just has on your type of business. It may not be your specific business, but your type of business, and then figure out how you can get that.
Mm-hmm. So again, if you listen to what we were saying, a lot of what we're talking about, it sounds pretty positive, and then at the same time we're talking about preparing and pivoting your business and things like that. Well, it doesn't have to be a recession, right? It doesn't have to be a global economic slowdown that causes these issues in your business. It could be industry specific. There could be something that impacts your industry. Maybe tariffs impact your industry. Maybe something that's going on in our local market impacts the industry. Or it could be something specific to just your business. In any case, the things that we're going to talk about next are things that you could be doing and paying attention to that can help you, one, to identify potential issues, and two, to combat those issues and to improve. So, qualitative versus quantitative, and Gary touched on this briefly, but you know, qualitative looks at the intangibles. So when I'm writing up a new loan, I might say that Mr. Smith has been operating this company for 30 years. He's been through many economic cycles. His successor, his second in command, is Mr. Smith Jr., his son. And you know, Mr. Smith Jr. has been working in the business now for about 10 to 15 years. They have a transition process in place where he will eventually succeed and take over the business. It's qualitative, it's really important stuff. The quantitative is more all about the numbers. You know, that's where we're going to dig in. We're going to really start looking at the numbers in your financials. What's more important? I wouldn't say one is more important than the other, but I will tell you from a lending perspective that quantitative is going to be what gets the loan approved most often. Qualitative is an important thing, though, because it's a tiebreaker. So if you have those loans that are on the edge and we say, yeah, but you know, these guys have been around for a really long time, they've proven themselves, you know, that could take a borderline loan and push it into the approval side. At the same time, you could have qualitative things like they're getting sued by like 3 of their vendors, and that could push you to the decline side. So they both matter. There's not, I wouldn't say one has priority over another when you're looking at your overall business.
I'd say if there's positive factors in the quantitative and qualitative, it's probably like 80-20 quantitative and qualitative. 80% of it, when Chris is getting ready to approve that loan, is going to be quantitative, and then that qualitative is that last little 20% that's going to distinguish you and push you over to where you maybe get a line of credit or a larger line of credit or get that loan or get more attractive rates because of the qualitative factors in your business.
Correct. So the financial report card, we're going to talk about 4 key areas in the 2 pieces of your financial statement. So balance sheet and your income statement. On the balance sheet, we'll talk a little bit about leverage and liquidity. On the income statement, cash flow and profitability. Just remember that your balance sheet, and this might be 101 because I know we have a lot of finance people in the room here, but just as a refresher, the balance sheet's going to be a snapshot in time, right? How much cash do you have in the bank today or on that date of that balance sheet? If it's a 12/31/18 balance sheet, it's how much cash was in the business that day. It's how much account receivables you had that day. How much debt you had that day, right? The income statement is showing you a flow of money in and out of the business, income and expenses, over a given period of time. So it could be a year long. It could be your January 1 to December 31st income statement, and that's showing you all of the income that came into that company, less the operating costs, less the cost of services or cost of goods sold, and you're going to end with your bottom line number, which is your net profit, net income.
I think what I run into a lot too is, especially with family-owned companies that have grown, it's like a mom and pop company, pop's selling the product or service, mom's doing the books. Hey, we're at $1 million in sales, $2 million, all of a sudden we're at $10 million in sales, and we're not really accounting for it properly. So we're not really sure what that profit is. We've got cash in the bank, but we may have deposits on some future business, but we recognize it as revenue. We may have paid our insurance for the whole year and recognize it all as expense rather than run it out over 12 months. So we're not really accounting for, unearned income, deferred revenue, prepaid expenses, all those types of things. And we may not have a real true picture of what that profit is. So a lot of times that's what we really need to clean up. And like when Chris goes in, or anyone at Centerstate or any lending institution is looking to take that snapshot and to look at that flow, they really don't have a good picture because they don't know what the numbers mean. And then they can't extend credit at that point in time.
That's right. So first thing we'll talk about leverage. And the way you use leverage, it's debt that's undertaken to invest in something or some kind of project or some kind of piece of equipment that's going to have a positive yield on your profitability. If you're using debt correctly, you're borrowing because it's going to make you more money, right? So that's what the guy's doing there. Brian, Brian got bored at my last one because he hates his finance stuff, so I put a lot of pictures in here for you. So, yeah, see that guy? He's using leverage to hold the planet up there. There's some key leverage. Sorry, I'll do animations next time. So I just put 3 of the main leverage ratios that you'll hear the most often: debt to worth, debt to tangible net worth. Debt to equity is probably one you hear more when you're talking about the Wall Street companies. With you all in the room who are probably mid-sized businesses, middle market type companies, the ones that you're going to hear the banks talk about the most are debt to worth and debt to tangible net worth. And a really simple calculation: total debt divided by worth of your company. The worth of your company is total equity, which would be assets minus liabilities. So debt divided by worth. Tangible net worth is the same thing, but we're taking all the intangibles out. In a lot of businesses, there's something called goodwill that you'll find, which goodwill can mean a lot of stuff. A lot of times it means that customer list or these things that have a value to you inside of the business and maybe a value to others who are going to buy your business, but they don't have a value to an outside person who's trying to collateralize the business. Whether we use one or the other depends on the industry. There's certain businesses where those intangibles are the whole value of the business. You look at medical practice is a good example where, yes, they have equipment, they might own a building, but the value of that business is the customer base, and that's something that's really hard to quantify. But in cases like that, we're going to consider that measurement. So what's good? What's a good ratio when you're looking at these? Typically, a really good debt to worth ratio or debt to tangible net worth means it's less than 1. So that means that you have more value in your business, more worth in your business than you do debt. When you go over 1, we start looking a little bit more closely, but we expect to see that in certain cases. Typically, if you're a rapid growth company, definitely if you're a startup. And then once you go over 2 or 3 times leverage, that's something where as a closely held business, as a bank, we start to get a little bit more concerned. Does it mean a definite decline on a loan? No, but it means that you might want to consider some debt restructure along with the new debt that you're taking on. Next up, we'll talk about liquidity. So, liquidity is cash. How much cash do you have on hand in your company? There's 2 main ratios that are used for this, current ratio and quick ratio. They're really showing you the same thing. It's current assets divided by current liabilities. And to put that in simple English terms, what that's telling you is if you were to liquidate your assets, could you cover all of your liabilities in your company? The current ratio looks at all your assets, all your current assets. The quick ratio looks at the ones that you can liquidate within a very short period of time, 90 days. So what would that be? That would be your accounts receivable, that would be your cash on hand, or your marketable securities. When we're looking at these, again, we're kind of looking at that worst case scenario to say if you had to liquidate, could you cover?
If you got $1.5 million in cash and marketable securities and receivables, and you've got $1 million in accounts payable and short-term loans, well, your ratio is 1.5 to 1, so you're in pretty good shape. If it's under 1, then it's not looking quite as good.
Correct. Yeah, if it's over 1, that's pretty much general rule of thumb. That's always a good thing. Got the little. That's for Brian again. Cash is king. You like that one?
As a KPI for our business, this stuff's great for the lending side, but from a measurable to say whether I'm doing okay, it's somewhat subjective, right? I mean, you're just telling me that I got cash flow in the business.
That's right.
Really what you're trying to see with this.
You're right. You're absolutely right. Yeah, and so we're gonna go through I think 2 more of these ratios, and then Gary's gonna do the exciting part, which is gonna tell you how to address all those ratios.
Yeah, 'cause
with
really,
the KPIs.
it's interesting because I think people confuse business ratios with key performance indicators, and these are really ratios that just take this snapshot and say, here's where we are. And the KPI, it looks in more depth at things in your business and then tries to help you figure out what can I do to go forward to do good things. And those good things, it's like the process we heard about, I think when Eric talked about it. We can't control the results, but the KPIs help us work on the process, and then the results end up being the ratios. And the ratios improve because we work on our process.
We had a real life example I can tell you about. I worked with a site work contractor. They're the first ones in. They get all the groundwork done when you're doing a new building project. These guys were one of the prominent ones probably in the Central Florida market at the time. And when the downturn happened, they were pretty much the first ones to feel it in the construction business because their work stopped first, So we had a pretty savvy owner of the company. He had been fairly conservative and not taking on a lot of debt. He was buying equipment used, going to the Ritchie Brothers auction and buying his front end loaders and getting all this stuff with as much cash as possible, maybe a little debt here and there, but he was very deleveraged. He saw the slowdown. He had to make a decision. He had all these assets he could hold on to. He could lay off employees because sales were starting to dwindle. Actually, he dropped about 70% in a 1-year period, if you can imagine that. This was somebody that had over 120 subs that were working with him at all times and had to cut that down to about 30, 40 key people. Made the really smart move at the time of liquidating most all of his equipment. And he did that because he wanted to afford to keep his best employees in the business. Continued to do some jobs. He didn't get down bid super crazy to win every job. He was pretty smart about bidding on the right jobs and keeping that cash pile. And then as things started to improve, he was the first one who was able to really mobilize and start acquiring equipment again. He started taking key employees from some of his competitors who had some really good people that they couldn't afford to keep on at the time. And it just, like a lot of businesses that went through that recession or any other recession, it made him leaner and meaner and stronger company. And he came out from it, and he's doing better now than he was at his peak during the last time. Cash flow. So show of hands in the room, has anyone for your business or maybe for personal investment purposes purchased commercial real estate? Have you ever gotten a line of credit for your business? Yep. Okay. So this is probably one that it's somewhere in your loan covenants. I'm guessing if you've done anything, over a few $100,000, where probably the bank is asking you at least once a year, for your financial statements. So they ask you for your tax return, maybe they ask you for an updated personal financial statement. The reason they're asking for all that stuff, one, it's because it's regulatory and that's what they force us to do, is look at that stuff every year. But part of it is that we're measuring loan covenants. So the most common loan covenant that you'll see on any business line of credit or on any commercial real estate loan is what's called debt service coverage ratio, DSCR or DSC, you'll see it listed as. Typically, they want that number to be somewhere between a 1.2 times and 1.3 times. And that means that for every dollar of debt that you have, you're bringing in $1.20 to $1.30 in profit. So I did just a quick example of what's called a global debt service here. Global is most often used in your small to mid-sized companies because it factors in the income of the sponsors, the owners behind the company. And the reason that's important is because a lot of your companies are probably S corps or LLCs. There's pass-through income, right? That income is eventually coming to you. So we want to look at you as an individual behind the company as well as we look at the business. So in this example, we take the net income of the company at $500,000, we add back their interest expense, and then their non-cash expenses, the write-offs, depreciation and amortization. That gives us the EBITDA, earnings before interest, tax, depreciation, amortization. Then we add in your personal income. This guy did pretty good. He paid himself $750,000 last year. So you get a $1.575 million global income. Then we go back to the debt side. We take the business's debt. The business had $500,000 in interest expense on their tax return last year. If we looked at their principal payments, they had $300,000, so they had $800 of personal or business debt service. Personal debt service of $300,000, that gives them $1.1 million global. So we take that 1.575 divided by the 1.1 million, global debt coverage of 1.43 times. We're probably looking for a 1.2 or a 1.25 on a company like this, so this is probably a slam dunk deal for us to do. The reason I mention this is because, again, it's something that you'll see on just about every loan commitment letter that you ever receive, and it's something that's going to be measured on an annual basis, so it's good to know how to measure it yourself. If you have a CPA, trusted advisor on the accounting side that you work with, they're going to know this in and out too, and they'll probably be able to tell you pretty quickly what your debt service coverage is, if you're wondering. A couple other types of ratios that are sometimes used, fixed charge coverage ratio. You see it in certain industries. And then UCA. UCA is interesting. It's kind of takes this, which is all income statement stuff, and it combines it with your balance sheet. Certain types of businesses, I see it a lot in construction where you're doing progress billing or percent to completion revenue recognition. The traditional debt service coverage ratio can be a little bit misleading because there's timing differences. If you're in construction, do we have any construction guys in here by any chance? A couple, okay. So in construction, right, you typically, if you're doing percent completion and progress billing, you're going to front load expenses in the beginning of a job. So if you start a job in December and then the bank looks at you on December 31, they're going to be like, gosh, your margins stink. If we look at that job a few months later, when you've gotten further into it, you've depleted all the expenses, and then you've gotten your 10% retainage that you collect at the end of the job, your numbers are going to look a lot better. So that's when we use UCA to kind of mitigate that, to make sure that we're getting an accurate picture of what your business is doing. And then this is a really easy one, profitability. Probably, this is the one that most people can spout off about their business pretty easily. What's your gross profit margin? What's your net profit margin? Why does it matter to the banks? Well, one, we want to know if you're profitable, but more importantly, we want to see how you compare to peers. So one of the things that a lender does is they look at that NAICS code, which is that little 5-digit number on your tax return and probably on your insurance and a lot of other things you deal with. And we put in your revenue range, and we pull up a bunch of other companies across the country. It's all anonymous information, but it's information provided through a lot of the popular underwriting software. And that shows us where you would compare to peers. So we're going to look at that to see if your gross and net profit margins are in line with those companies.
I have a question for you.
Yeah.
On the NIC codes, they're kind of antiquated based upon the world's technology pace of business.
You're right.
It's hard to get a NIC code that defines my business today because I'm kind of in a niche market. How do you get classification? I mean,
We struggle with it a lot, and you're right. And so there's a lot of times where we look at the NIC code on the tax return, we're like, well, that's really not what these guys are doing, In those cases, sometimes you can find the other areas where you can find profit margin, peer comparison information. Sometimes it's through like business intermediaries, companies that do business brokerage, because they've been buying and selling these types of businesses. Sometimes you can find data that way. Sometimes you can't,
That's a great idea. Is that open? Because I'd love to be able to see that myself. It's hard to say.
You know what I will do, just because, and you've asked a few good questions about a few resources that I can probably share, and as I'm talking, I'm thinking of more resources I can share. I will get with Jeff and make sure that I get a list of a few websites out to you that I think would be worth looking at, and I'll make sure that goes out to the group. Okay?
One way to look at it, find out who is the direct competition to you. You should know your competition. Use that code.
Yeah, using your competitions code, sure.
Direct competition. Try to figure that out, find out what the code is.
That's right. This is just a real kind of a simple summary of sources and uses of cash. I think this is always it's kind of a counterintuitive thing for some people because we focus a lot as business owners on sales and profit too, right? But I think a lot of times we're starting with the sales. When we talk about sources and uses, this is really where financing becomes a need for a company. So the thing I want you to remember is that when we talk about an increase in your accounts receivable, that's going to be a use of cash. It costs you money because now you have to convert that AR into cash and into profit for your company. And you're going to do that through completing the work. You're going to spend money on labor. You might spend money on materials, cost of goods and services. And then you also are probably going to have to spend money on collections on some level. Hopefully that's an easy phone call, or you send in mailing a bill out or emailing a bill out, but sometimes it takes a little longer, right? Same thing with cash outflows. When we talk about uses of cash. So a source. What's interesting is debt is a source of cash, right? You take on debt that gives you cash, but you have to pay it back later. So the thing that you have to think about is the rate that you're borrowing at, and then what kind of growth is it going to facilitate for your company? Does it truly make sense? Are you borrowing just because you want to borrow to fulfill a job because you don't want your competitor to have that job, or are you truly going to actually make profit from that job that makes sense for you? Is it going to hit your margin goals? So Gary's going to talk about how these ratios really relate to your business and what kind of KPIs you can develop that will help you to improve on maybe the ratios where you need a little bit more help.
I think Jeff mentioned there's like hundreds of different key performance indicators, and we tried to distill it down into maybe 10 or a dozen of them here that we can talk about for a couple minutes each that we can touch on and maybe see if you're thinking about these, if you're not thinking about them, how you can start integrating them into your plan and into your team's plan. And the first one is cash flow forecasting. We've been talking about that. Chris talked about it. Raise a hand. How many of you have a cash flow forecast for your companies? Maybe where you're going out, here's what it looks like over the next week by week, the next quarter. Here's what it looks like month by month for the next year. For those of you who don't, I mean, it's vital, and it seems like every company that I go in to help with some part-time CFO services, they either need a little help in it, or some of them aren't even doing it. And it's vital that we understand the inflows of the revenue that are coming in from our big contracts, like Chris mentioned. We both have worked with some contractors, and if ABC roofing or ABC electrical company has a big job and they don't understand, this is when the revenue is expected to come in, and they can plot that out. Here's when we're expecting to pay our subcontractors. Here's when we're expecting to pay for our materials. Plot that out on their jobs, and then have another tab on their cash flow forecast, which flows forward, that has all the G&A type expenses. You have to have that to really understand where you're going to be, and to see if there's any seasonal changes. Do any of you have seasonal businesses that maybe they're stronger around the holidays or stronger in the summer? If you do, the revenue could go up and down, and the associated direct costs could go up and down, while those fixed costs for G&A, marketing, sales, IT, et cetera, are flat the whole time. By doing that cash flow forecast, you'll see if there's some trouble spots out there where it's like, oops, it looks like things are going good, but when we hit September, October, our business drops off a little. We may have a need for some cash. It looks like we need to talk about that now with our lender and get a line of credit set up or something, instead of, oh my God, we're not going to have enough cash next week. I better call Chris and see if he can get me some money in 3 days. That's probably not going to work.
Short-term cash fluctuations are expected in a business, especially in a business that's experiencing a lot of growth, and that's something that Gary and I communicate about all the time. So You know, sometimes when I get a cash forecast, it's all positives, and that's great. But then I'm like, well, why do you need the loan from me, right? It doesn't really make sense. So we're expecting to see some fluctuations where you might have those negative weeks, and that's really what short-term working capital is for.
Gross margin, gross profit margin as a percentage of sales. Again, there's a couple different ways you can look at that. One, if you have multiple locations or if you have multiple product lines, you can look at it and compare within those and see where they are. And then also, as Chris noted earlier, compare to your peer group. If you're selling appliances and your gross profit margin is 45%, but in the industry it's normally like 49%, well, 4% on sales of $10 million, is $400,000. And so why are you realizing $400,000 less on those $10 million in sales than your competitor is? And you may need that, especially if your bottom line's only a couple $100,000. You potentially could triple your bottom line by looking at that. What are the reasons for it? That's the part where you have to delve in and figure out if there's something your sales team is doing different, something in your marketing team is doing different. Are you undercutting your competition more than you need to? There could be a lot of reasons, but the real key is to look at that gross profit margin as a percent of sales and determine, is it where it really needs to be for what you're doing? Another thing to look at with the gross profit margin in general is during the course of the year, your gross profit margin is going to contribute a certain amount of money that's going to cover your fixed cost. So we need to see what our fixed costs are and then determine at what sales level we're at the break even, both in profit and in cash. So if we have $3 million in fixed cost and we know our gross profit margin is 50%, well on sales of $6 million, our gross profit margin is going to be 50%, and that's going to cover our $3 million in fixed cost, and we're going to break even profit-wise. So we know, okay, $6 million is where we're just barely treading water in sales. So we want to get to a higher amount. So these key performance indicators help us figure out where we need to be. They may not tell us what we need to do to get there, but they give us a path. This one gives us a pathway of where we need to be. Then we have to implement plans through our strategic plan to get there. And that's the sales volume to cover the fixed costs. Very, very important. That's the one that you have to do or you're going out of business. Anybody struggle with that, where you don't know what that number is?
Yeah, I definitely don't know what that number is, especially with everything changing to more of a utilitarian type of services. There's so many things that are moving over to recurring revenue models for the market that's coming back to us business owners. I got guys in my IT department constantly going, oh yeah, we got Cloud 365 now. That's a monthly charge now, okay? I got it now changed from this thing that I thought I bought once every 3 years or 2 years, and now I got to start looking at it. So it's a big headache in my world right now, trying to get that wrapped up.
So quantifying those fixed costs is vital because you really can't point toward what sales value need to be at if you don't know those fixed costs that you're going to have to cover, and some of them are recurring, like payroll or IT or insurance or whatever, and other things could be a little more variable, but most of them are pretty fixed in that G&A, marketing, IT, sales area. Revenue growth rate. Well, if we're not growing our business, where's Daryl? Daryl, how much do you want your business to grow every year? Minimum of 25%, and why is that number important?
Just from past experience, to be a growth company, 20% is sort of the minimum that I've always worked off of. We're a relatively small company, so the percentages are a lot easier to hit than if we were a large company.
Are there people in here whose growth rate, when you look at here's where I was in 2016, 17, 18, 19, is like less than 10%. You don't have to read. So if it's on that lower part, you're moving forward, but then what happens is if there's a recession, you may not have quite as much wiggle room as if you're growing at a faster.
Doesn't it also have to take into account if you're in a mature industry or a mature business? The ability to do 25% a year is
Totally different.
Absolutely.
Versus
Yes.
I'm a startup, if I do one more client, I just did 50%.
Right.
I think we ought to put that in perspective.
Exactly.
That's
Well,
very
and it
true.
does depend on what you did. Earlier when we heard about, are you an entrepreneur or not? And, it's like me, I only have so much time to do CFO services, and then I have to do admin stuff. So if I'm doing 45 hours a week of CFO services, another 10 hours of admin stuff and this and that and driving around, well, pretty soon I'm at 65 hours. And because people are paying me for my brain and for me to think and stuff like that, there's sort of a limit to what I can do. It's not scalable, versus other types of business.
The other comment you guys were talking about knowing your fixed costs. So I'm a service company. A lot of my clients retain me. We agree on a fixed monthly fee, and they get to pick my brain for whatever reason. But what I have to be careful of is if they go over that amount, my fixed costs are the same technically, but to Joe's point, I've only got so much time left. Well, it gets really cumbersome when I've got a number of employees, we're all on retainer, and next thing you know, the client has sucked dry all of our time. My fixed costs didn't change, my salaries were exactly the same, but I still find myself in a negative situation because I have more billable time now.
Right.
Well, so then you,
Joe's initial comment.
yeah, you got to do what Joe said. Sometimes when they say, can you do this, can you do this? You may have to say, I can't do it unless there's an additional charge. Yeah, and you might have to figure that out. And they may
My
decide.
banker points that out to me often.
Yeah, so the client would probably value that. You can say, however you couch that and however you mention that to the client,
Client wants as much as they can get for as little.
they want, yeah, they do, and they do. And if you tell them, beyond this point, I'm going to have to charge you more, and that's their decision whether or not they would like you to charge them more or not provide what I'm sure is very valuable, advice. Relative market share, yeah, we talked about this a little bit early in passing, your relative market share. And this is in your market, probably in whatever area you're serving. So if you're serving Central Florida, it's what is your market share in Central Florida? And then the opportunities are too in Central Florida because we're growing. Somebody's got to serve all those new customers and new people moving in. And then can you do things better than your competition so you can have some of their market share come over to you? So there's really two ways to grow your market share. And if you have 5% of the market, you obviously have a lot better opportunity to grow than if you have 60% of the market. It's sort of like, I think one of the easiest ones to see is when you see the personal injury attorneys ads. They're saturating because they know that's how they get results, and the market is slowly growing, and they're fighting to keep market share or to get it from the competitors. Same thing with car dealerships. There's certain advertisements you see the most. Those are the ones that are effective on television. Personal injury attorneys, auto sales, furniture sales, those types of things. But in your own company, is there anyone who's got such a big market share that they don't think they can grow their market share? Or can anybody, God, we control so much of the market that we can't grow anymore. We just, no. So then the key is when you're working through your strategic plan and your SWOT analysis and all those other things that hopefully you're doing, or if not, talk to me, because that's what we like to encourage people to do and to do a better job of. And sometimes even if you are doing it, an outside thought process can help guide that in ways that you wouldn't expect and can bring better results possibly than if you just do it on your own. That can help you to figure out how are we going to grow our market share in what is a growing economy here in Central Florida.
I think the next two kind of tie together pretty well, right? Because it's like the eggs in a basket stuff. So revenue, income sources, revenue concentration, sources of your sales, and then looking at AR, right, from a revenue concentration.
I think these are maybe two of the most important things you can think about in your business. Is are you spreading out the types of income sources, and then within those sources, how concentrated are you?
Gary, it seems that of late, especially with the demographics of the business owner community, folks are getting ready for exit and things like that. Folks talk so they can validate the strength of the income sources, and if there is customer concentration, what's the quality of those revenues? Can you speak to that a little bit?
Sure. Yeah, I mean, for example, say you're a construction subcontractor, whatever you're doing, whether it's electrical or roofing or plumbing, if all of your income or most of it is coming in from, say residential construction. Yep, we do a lot of work with Lennar and we do a lot of work with Centex. If part of that is coming in from there, but you're also doing work with a company that's building assisted living facilities, and they're planning on building 10 of them over the next 15 years, and you're doing work with them. You've also got a government contract to provide your services, maybe with the city, with the county, you got one with the state. You also do some residential, and you've split it up into a lot of different income sources. That's that quality of earnings that Jeff talks about. Somebody looks at it and they say, wow, this company's doing electrical work, and all of it is for like 3 big home builders. But if they're doing electrical work and they're doing it for 3 home builders, they're doing it for 2 different assisted living facility companies, they're doing government work, they're also doing amounts of residential. The quality, and if everything else is the same, their sales, gross profit, fixed costs, they both have the same bottom line, the company that has a variety of income sources is going to be more valuable and is going to sell for a higher multiple of earnings upon exit. So think about what you're doing, and think about, are there other opportunities out there to do what we do with our sales and marketing to spread the income sources. And a lot of times sales and marketing is headed up by the CEO, so it maybe you have to look at yourself and figure out how we do it. I have to do the same thing. All of us need to do that. Revenue concentration, that's, does anyone out there have like a big client that's like more than 1/3 of their income? Yeah, so what's gonna happen if that client goes, you just, every day, Lord, please, I want that client to stay. I need that client. But that's scary when you think about that. You're so happy to have this large client, and but if that large client goes away, it's like, what do you do? That's part of talking about what gross profit do we need to pay our fixed costs. Probably a good modeling would be to say, geez, let me pretend that tomorrow that client goes away. What are my what's my revenue, what's my variable cost, what's my fixed cost, and am I still in business? And if the answer is, whoa, I'm not sure, then the next plan has to be to spread out that client base somewhat. I know Russell Slappy with Nperspective, he had one client, and they had a government contract over a period of a few years, and it was like a $60 million contract, but that was their only client. And then when it went away, or they knew it was going to go away, he had about 6 months to help that client find new business. So Russell, part of his CFO and strategic consulting that he was doing wasn't as much financial as it was helping them to find more clients. And he changed his focus and focused on that the most, and helped them to find more clients going forward. But think about that. I think income sources and revenue concentration are possibly the 2 most important things that you got to think about in terms of the value of your business when you exit, and also sustainability if we hit a bad time. If everything you do is in one market and that market falls out, it's a discretionary retail, and then we go into a recession and people quit buying high dollar, whatever it is, items, boats or purses or luxury cars, then we're in trouble. If it's construction, and the economy goes down like it did in the late 2000s, and the housing, like new housing sales in the state of Florida were decreased from a level they were at to 20% of that level. So if all you're doing is servicing construction, residential construction, boom, you're in trouble. So.
And I just want to point out, we're talking about this in a classroom setting. It's really easy to critique this stuff and talk about how you just need to like shift into a new business.
Oh yeah, just go get some new clients.
Easy, right? So just realize we're talking about this in a very clinical way, but talk to Gary and I one-on-one if you have any questions afterwards. We'd be happy to speak with you specifically about your business and share some ideas with you that maybe things we've experienced with other clients. And we're going to wrap up, but thank you guys very much, and we appreciate your time today.
All right.